The Goods and Service Tax Act or GST would subsume most of the taxes like excise duty, service taxes, various state VATs, entertainment taxes, etc. There is a destination based tax levied on supply of goods and services simultaneously by both the state and central governments. So the cascading impact would be an event of past. Would benefit consumer states such as West Bengal, while manufacturing states such as Gujarat and Tamil Nadu would initially lose. Input tax credit would flow uninterrupted and businesses would become boundaryless. Compliance would become easier due to uniform rates and definitions under the Act, but one-time costs would have to be incurred for getting GST ready. GST would benefit both businesses and consumers as tax incidence would come down due to simultaneous levy. Businesses would also benefit as uninterrupted input tax credit would bring down overall cost of supply, and this would percolate at least partially to the end customer. Reduced cost of supply would improve competitiveness of Indian exporters. The tax rates now fixed at 5, 12, 18 and 28% with an additional cess on sin and luxury products would mean businesses subject to tax rates lower than GST rates may face margin pressure. For example, the cotton chain within textile which currently pays zero excise duty. On the other hand, businesses which currently pay higher taxes may see margin expansion. For example, cement industry which currently bears a tax burden of 24 to 26% may see margin expansion if taxed at 18%. As tax boundaries fade and nation becomes the market, warehouses would consolidate. Stocking points will reduce, goods would move faster as movement would mostly be tax paid. All this would lead to lower channel inventory levels in the entire system. The input tax credit would flow uninterrupted, leading to lower cash outflows on account of tax and would reduce working capital requirement for businesses. Taxing stock transfers would, however, have a negative impact, but would be a one-time adjustment of working capital, and this, we believe, would be more than offset due to positive impact of uninterrupted input tax credit and lower inventory levels. Services are likely to become costlier at 18% GST, but ability to set off input service tax would improve. For example, FMCG companies or entertainment companies like a PVR or Inox operating in rented premises would now be able to offset tax on input services against tax liability of F&B or entertainment tax. The central government would compensate for any revenue loss to states due to GST's implementation. Revenue growth rate for states has been fixed at 14%. Tax exemption given to industries set up in 8 northeastern states and 3 hilly states would also be included in calculation of revenue loss. More clarity is required on fate of industries set up in other states and exemption schemes of central or state governments. We believe that a mechanism to continue the exemption would be worked out to compensate these industries. Few items are outside the purview of GST, like the electricity duty, the stamp duty, petroleum products, etc. This breaks the chain of input tax credit for businesses as electricity duty would still remain cost. Similarly, stamp duty remains a cost for real estate industry. Procedural issues related to transition phase, clarity on issues like valuation of transactions in case of free supplies, difficulties related to claiming input tax credit set off. For example, the Model Act states that the recipient of tax credit is liable to pay additional tax if there is a mismatch in input tax credit and output tax liability filed by his vendor. The mismatch would be communicated to the recipient while it has to be rectified by the vendor. A delay on vendor's part would mean additional tax liability on the recipient and would entail cash outflow.